People use Bitcoin as a speculative asset, right? It's like gold. It's just like gold, only it's virtual, it's digital. People are not using it as a form of payment or as a store of value. It's highly volatile. It's not a competitor for the dollar. It's really a competitor for gold.
That was Jerome Powell, the chairman of the Federal Reserve, just over a year ago. In the clearest terms anyone had ever heard from him, he described Bitcoin's role on the world stage. He didn't announce a new policy or a sweeping regulation. He just stated a fact. And in doing so, he crystallized a shift that institutions were already quietly making. For years, the one question that kept trillions of dollars on the sidelines was, what is Bitcoin? A currency? A tech stock? A payment network? Powell's comment didn't just add to the conversation. It practically ended the debate. It's not a threat to the dollar, he said. It's a rival for gold. This wasn't some off-the-cuff remark. It was a demarcation. It was the signal that pulled Bitcoin out of the messy pile of thousands of other crypto assets and put it in a category of its own, a global, non-sovereign digital store of value. And understanding what happened after he said that is the single most important thing for any investor today. So what happened? Let's break down what that moment from late 2024 really meant, because the nuance is everything. When a Fed chair speaks, every single word is put under a microscope. He isn't just sharing his thoughts. He's signaling how the highest monetary authority conceptually understands Bitcoin's role. And for years, that view on Bitcoin was skeptical, cautious, and sometimes even dismissive. In the past, Powell and other regulators hammered on about Bitcoin's volatility, its use in illicit finance, and its failure as a way to pay for things. That was the official story, risk and containment. But his statement at the DealBook Summit was different. It wasn't a warning, it was a classification. Let's look at those words one more time. It's not a competitor for the dollar, it's really a competitor for gold. This one sentence does two incredibly important things. First, it politically de-risks Bitcoin at the monetary level by removing it from the threat to sovereign currency category. He was signaling to the entire US regulatory machine that Bitcoin isn't trying to replace our money. This tells regulators they can approach it more like a commodity, like gold, oil, or wheat, and less like a rogue currency. That fundamentally changes how you regulate it. Second, by naming gold as its competitor, he essentially gave Bitcoin a job description. Gold has a well-understood, multi-trillion-dollar role in the global financial system. It's the go-to asset when you want to store value outside of any single country's control. It's the hedge against inflation and chaos. Powell's comparison, whether he meant it as an endorsement or not, put Bitcoin right in that arena. He wasn't saying Bitcoin is gold. He was saying it's competing for the same job. Now, he was also quick to call it a speculative asset and pointed out its volatility, which is just a statement of fact. This wasn't some glowing recommendation. It was a pragmatic acknowledgement of reality. He wasn't telling you to buy it. He was telling you how the system now sees it. For years, the market had been making this case, and here was the head of the Fed finally, publicly, agreeing with the market's conclusion. This was the signal through the noise. This was the moment the official story started to catch up with reality. And that had massive consequences throughout 2025. So, what did this mean for the big money? The pension funds, the endowments, the sovereign wealth funds. For years, these massive pools of capital were stuck on the sidelines. Their problem wasn't just the volatility, it was career risk. An investment committee needs a defensible reason to put money into something new. Powell's statement wasn't a permission slip, but it gave them something far more valuable, a map. It provided a framework, coming from the highest monetary authority, for how to categorize Bitcoin. Suddenly, a fund manager going to their investment committee to propose a 1% allocation wasn't pitching fringe internet money anymore. They were proposing an allocation to digital gold, an asset competing in the same weight class as the most respected store of value in history. That tiny shift from "what is it" to "this is what it is" was monumental. The question inside those boardrooms was no longer if they should allocate, but how much. It became a straightforward question of portfolio math. In a world with stubborn inflation, How much of your portfolio should be in a non-sovereign digital store of value? And we saw the system adapt to this new reality throughout 2025. On April 24th, 2025, the Federal Reserve and the FDIC formally withdrew old supervisory letters that had made it difficult for banks to get involved with crypto. They removed the requirement for banks to get prior approval for permissible crypto activities, shifting instead to monitoring them through the normal supervisory process. While Powell's words didn't cause these changes directly, they reflected the same internal shift happening across regulators. This was the system evolving. Regulators recognized that crypto isn't going away, and that supervised banks needed a clear path to engage with it. This built the plumbing for institutional capital to finally flow. Powell's statement gave them the story, and these regulatory shifts gave them the tools. Together, they unlocked the door. To really get why this is such a big deal, you have to look at the broader economy. For more than a decade, the answer to every crisis has been the same: create more money. This environment systematically punishes savers and devalues the very currency, the dollar, the euro, the yen, that we measure everything against. In a world like this, the biggest challenge is finding a place to store your wealth, your economic energy, in something that can't be endlessly diluted. For 5,000 years, that something was gold. Gold is scarce, durable, and nobody can just print more of it. But gold has its limits. It's heavy, expensive to secure, and difficult to move or verify quickly. Now look at Bitcoin through that same lens. What is it? It's the first thing in human history that combines the scarcity of gold with the speed and efficiency of digital information. It has a hard cap of 21 million coins, locked in by math and enforced by a decentralized global network. That's real, verifiable scarcity. It's weightless. You can move $1 billion worth across the world in minutes with nothing but a passphrase you could memorize. And it's permissionless. If you hold your own keys, no bank or government can stop your transaction or freeze your funds. When Jerome Powell calls Bitcoin digital gold, he's acknowledging these fundamental traits. He's confirming it belongs on the same playing field. This means Bitcoin's value is no longer just about tech hype. Its price is now increasingly driven by the same big picture forces that move gold: interest rates, global liquidity, and faith in government-issued currencies. And this is exactly why understanding macro mechanics matters more than watching daily price charts. If you want to really understand how liquidity, inflation, interest rates, and policy decisions flow through assets like Bitcoin, I put together a macro investing masterclass. The entire first module is free. No card, no catch. And it walks through the foundations so you can think about this system clearly instead of reacting emotionally. If that sounds useful, the link is in the description. We saw this play out in 2025. As the Fed signaled a softer policy with potential rate cuts, the appeal of assets that don't produce a yield, like gold and Bitcoin, naturally grew. A weaker dollar has historically strengthened Bitcoin's case as a hedge. The market is now starting to treat it as a high-octane version of a global liquidity gauge. When the money printer turns on, Bitcoin tends to respond, often with more force than its old-school analog counterpart. One of the most profound takeaways from Powell's comment is what it means for the future of money itself. By drawing the clear line between Bitcoin's role and the dollar's role, he created separate lanes for different digital assets. This isn't a world where Bitcoin has to kill the dollar to win. It's the opposite. The lane for payments and everyday transactions remains the domain of the dollar. This is where stablecoins and maybe even central bank digital currencies, CBDCs, will live. The regulatory frameworks we saw take shape in 2025, like the Genius Act passed in July, are all about creating rules for dollar-backed stablecoins to make them safe and reliable. The goal is to upgrade the dollar's payment infrastructure for the digital age. Bitcoin sits on a completely different layer. It's not the checking account, it's the gold vault. Stablecoins are for spending. Bitcoin is for saving. It's where you can store long-term wealth that you want to protect from the slow-motion debasement that happens on the transactional layer. This two-layered system is actually ideal from a central banker's point of view. It lets the dollar keep its crown as the world's primary currency for trade and accounting, while giving people a regulated, non-threatening escape hatch to hedge their savings. You can protect your wealth in digital gold without ever leaving the dollar ecosystem for your daily life. This separation of duties is brilliant. It allows the US to support a vibrant stablecoin market to keep the dollar competitive, while also letting Bitcoin mature into an institutional-grade reserve asset. Powell isn't trying to stop Bitcoin, he's putting it in its proper place. And that place is as a competitor to gold, an asset the Fed has coexisted with for a century, not a competitor to the dollar, which it would be forced to crush. The financial world has a new map. The rules are being rewritten as we speak, and the people who understand these shifts are the ones who will be ready for the volatility and opportunity ahead. The signal has been sent. The institutions are reacting. If you want to stay ahead of these trends and understand what it all means for your money and your future, make sure you subscribe to the channel and hit that notification bell. We're in a time of incredible change, and our job is to find the signal in the noise together. So, where does this leave us? Jerome Powell's statement wasn't the starting gun. It was just the official acknowledgement that the race had already started. He just said out loud what the smartest people in the market had figured out years ago. In doing so, he slammed the fast-forward button on mainstream acceptance. The world is now neatly divided into a before and an after. In the world before, Bitcoin was a weird, speculative, and professionally toxic asset for any serious portfolio manager. It lived in a regulatory gray zone, feared by watchdogs and dismissed by Wall Street. In the world after, Bitcoin has a defined job: digital gold, a speculative store of value competing for a piece of the multi-trillion-dollar market for non-sovereign wealth. Its legitimacy as a macro asset is no longer some fringe theory. It's a description used by the chairman of the Federal Reserve himself. This doesn't mean the volatility is gone. It doesn't mean the price only goes up. But the big, fundamental debate over what Bitcoin is has been settled in the minds of the institutions that control most of the world's money. The conversation is no longer about why, but about how much. Institutional investment in 2025 proved this out, with year-to-date inflows into spot Bitcoin ETFs totaling nearly $48 billion by late December, showing that real capital is treating Bitcoin as a long-term strategic asset. This flow of institutional money helps to reduce volatility over the long run, though short-term volatility remains part of the asset's nature. This creates a virtuous cycle of stability and demand. The last barrier to massive institutional adoption was never technical. It was narrative. It was the lack of a clear, officially sanctioned story for what Bitcoin is and where it fits. Jerome Powell, whether he meant to or not, handed them that story. He didn't endorse it, but he defined it, and in doing so, he may have helped uncork the most significant reallocation of capital into a new asset class we've ever seen. The job title has been assigned. Now, the real work begins.